Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. We had the headlines coming through this morning on United Health and Humana plunging 20% after the Trump administration proposes to keep the Medicare Advantage rates flat, rather. He tried to say, as Rob would say. And we also have Mozilla is building an AI rebel alliance to take on the industry heavyweights such as OpenAI and Anthropic. So lots of drama and exciting topics and headlines to start this week out. And interested to see those implications play out in the market throughout the week. And of course, very excited to interact with you all. So let's kick off. Rob, how you doing?
Good, Zach. How are you? Hey, everybody. Welcome to TradeFinder Live. If I can get to the share button. There we go. Hopefully everybody will be able to see soon. There we are. Hope you've had a great start to your week. Hope it's a little bit warmer wherever you are than where I am. It's 5 degrees last night and this morning, and we're supposed to work our way all the way up to 29. So quite cold here, but I know other places had it a whole lot worse. So we'll talk about that more when we get to energy. But for now, let's take a look at the chart of the S&P. And you can see that we are breaking higher again today. We've come off the highs, though, just in the last 30 minutes. So it's going to be important to see where we close today. I was talking during our EWO Trader Live show yesterday that although we did make an important break of that 690 level yesterday, it didn't really carry as much weight, I don't think. If we look at the volume, you can see why I say that. I made this comment Thursday night during our insiders meeting. We've got kind of a running joke of what's going to be interesting on Friday. And with the storm coming, I felt like a lot of people were just going to hunker down. A lot of traders weren't going to come into the city, and there would likely be less volume in Friday's market. And that was true. You can see lower volume than what we've had for quite some time, other than the Christmas holiday break. And then yesterday, felt the same way with Monday's trade due to the fact that a lot of people were digging out from all that snow that they had. A lot of people were literally snowbound. I've heard people that were icebound. I haven't heard that term before, but it was a pretty significant storm. So my point is the break of that 690 resistance level, you have to take with a little bit of a grain of salt because it was on lower volume. And as we talk about, oftentimes lower volume markets tend to drift higher. And that's not really what you want when you're breaking a point of resistance. We've been looking at this 690 level all the way back to October as resistance. We tried to break it earlier in the month. Then we had all the tariff, Greenland, Iran stuff, and that put the markets back down. But we turn around, pardon me, and rallied right back up. And we're underneath the resistance level on Thursday and Friday. So we broke it yesterday, but again, not putting too much faith in that move. So we wanted to see, felt like today we'd have more volume. We'd get the majority of traders would be back. Volume would be higher today. And could we follow through with that move yesterday? We got off to a good start, but as I said, we've given some of that back here in the last 30 minutes. So where we close today will be very important for what happens in the next couple of weeks if we can continue to break out of this big ascending triangle pattern and run higher to extend this wave 5. I'm cautious on the wave 5 as well because the wave 4 only went to 21%. And Elliott would talk about how he didn't really respect a wave 4 correction unless it went to at least 30. Obviously, pardon me, preferring the correction to go down to the 38.2% fib level, but at least if we got to 30, it was okay. And with only a 21% wave 4 correction, you expect oh, pardon me, a lower extension level on the wave 5. What would be most ideal is with a weak pullback in the wave 4, so far a weak extended wave 5, that perhaps that 5 relabels to a 3 if we could get some strong volume in here to back that up. If we take out this high from last week or 2 weeks ago on good volume, there's a chance that relabels to a 3. Otherwise, I think there's a limit to how far this wave 5 can go, being the fact that the wave 4 only retraced to that 21% level. So cautiously optimistic, likely to move a little higher, certainly not in the all clear zone yet as far as the market's continuing up. So all that bears watching. Quick look at the VIX. We're back down towards that 15 level. We spiked up on all that noise that came out over the holiday weekend, and now we're right back down to this level around 15. We had talked, or I had opined, at the end of the year when we got into the Santa Claus rally and the first part of the year time frame. We didn't really get a Santa Claus rally. It was kind of a downward move that was quickly retraced. But could we start to drift down towards this 12 and a half level, which, if you've been watching, you know, was support in 2024? Hasn't happened yet. 15 continues to be a stubborn level of support on the VIX, which means as long as we sit here, better chance that there's going to be another one of these spike ups in the VIX. The positive, if you're looking for positives, is that the spike higher on the VIX, as we keep bouncing off 15, have been lower. So a whole set of lower highs supported 15, giving us a descending triangle pattern. You know what that means. So likely some sort of a breakout in the markets. And um, if you're long the market or you want the market to go up, then you want this to break to the downside. The issue is there's really limited room for a break lower, honestly, because 12 and a half is going to act as a tremendous amount of support, and this triangle is much bigger than that. So again, you have to keep in the back of your mind that there's a possibility of another spike up and at some point in time, a significant move in the VIX. If we go look at what's happening in the bond market, TLT, prices on the 20-year, prices and yields move inversely. I know I say that incessantly, but we add new people all the time. So please bear with me if you've been watching for a long time and you're like, I know, I know, I know. But other people that are new may not have heard me go through this in the bond market. I'm a fan that you should have a working knowledge of the bond market if you're an equities trader or derivatives trader, i.e., options in the equities market. You don't have to be an expert by any way, shape, or form, but there's so much money in the bond market and a lot of smart traders. Oftentimes, the equity markets take their cue from what's happening in the bond market. So that's why we pay attention to it and show it each and every week. A little bit of a tick down today, but we had a pretty big jump up yesterday. So that means that prices went up on the 20-year, longer end of the curve, and that meant yields went down. Today, we're giving some of that back, but we gapped up. So no harm, no foul, just gap filling today. We're trading right around the 50-day moving average. Perhaps this wave 5 to the downside holds. It's getting into the area now of satisfying the head and shoulders pattern. We had already satisfied the zigzag with that 50% B wave correction, giving us 100% extension. And I keep talking about this. If people don't follow zigzags, they're really missing out. It can tremendously help you in your directional trading. We just pegged there for about 2 months, holding in that level, and now we'll see where we go from here on TLT. We've almost retraced back to the previous 4. So if that wave 5 is done to the downside, you expect to move back up to the 4. We're almost there. That's when things get a little confusing. That is the one time in Elliott Wave where you kind of just sit back and wait and see what the markets have in store. What's the next impulse move going to be? When a wave 5 pattern ends and the retracement back to the previous 4 is complete, you kind of have to wait until the markets tell you what the next impulse move is, what the next pattern is likely to be. So a little bit of uncertainty there with where we go in bonds, not going to be helpful to the equities market. Pardon me. Here's TNX, which is rates on the 10-year. So TLT is prices on the 20-year. TNX is actual rates. And you can see this move back down, filled the gap here. Now we're back down to 420, which acted as resistance for a long time, 4.2% on the 10-year. We sat there for nearly 2 months, month and a half. Then we had the big breakup on the volatile move, the noise that I mentioned before, and we're right back down testing that level. And the question becomes, does 4.2% become support? That would imply that rates go higher. That could also imply that maybe TLT's wave 5 isn't done yet. We don't want to see rates go too significantly higher if you're long the market again, or want the market to go higher because higher rates not conducive to too many places in the equities market. That's a concern. So we look at the dollar. The dollar is breaking down. As you can see, we're finally out of the Goldilocks, as I've been referring to it, channel. We did break it back in September, and we're able to turn around and get right back into it. We'll see if that happens. So I don't like the fact that the dollar is breaking down. It makes you wonder. It is good for exchange rates, so companies with international exposure like it. But we don't want to get to the point where countries become so concerned about our dollar that they start dumping dollars. That's where the problem, could come in. We're a little bit below the 10-day moving average on the dollar now. And again, is something that I'm keeping an eye on and watching. That could create a whole big can of worms if the dollar were to start significantly moving lower. And I won't worry about that unless we take out this wave 5 low from September. But if we do, I'll start to get concerned. But we do have a last bastion of support, if you will, pretty far down around 90. And we were able to do okay during that time frame. So it's not the end of the world if we break below 96, but it could very well be a fairly swift move lower. And that's going to make headlines. All the financial media will be talking about the dollar's collapse, the big tanking in the dollar, all this kind of stuff would be hitting the financial wires. And so we just don't want to hear that. That creates confusion, uncertainty, and markets never perform well in that environment. Let's take a look at where we are on the Dow. So we look at the DIA and bounced down a little bit, having a fairly weak day in the Dow compared to the rest of the markets. But we ran up to this 495 level. I was really surprised that we didn't move up to 500 before we had a pause in the ascent higher. Clearly, 495 is a significant point of resistance. The wave 5 is getting rather extended at 142%. Definitely not like what's going on the S&P, where we had a weak correction and a weak extension. Very strong extension here in the wave 5 on the DIA. Same question comes up because you can't go too much higher here. I use the analogy of like a rocket going up and starting to run out of fuel. It gets into that real thin air and just rolls over and comes back down. And that can happen. The further extended away you get, the greater chance there is of a more volatile move back down. So it could be more significant coming down. We could go up to 161.8. That all made sense. I oftentimes say the market doesn't give you the ideal scenario very often, but it would have made sense that the wave 5 extends up. We hit 500. That's right around 161.8% extension. And that's where we find resistance. All that added up and made sense, but the market has other ideas, at least for now. We could obviously turn and move back higher and still go up to 500 and still do those things that I just mentioned. Maybe the Dow needed a break first. The one positive here in this scenario is that we do have a pretty nice set of higher lows here on the DIA. And with that resistance level, at 495, creating a rather large ascending triangle here on the DIA. So some sort of a pretty good breakout coming there as well. So we're going to get some action in the markets here pretty soon. But as you know, with triangles, we don't know which way that's going to be. And so there's enough to be cautious about across what I've just mentioned. And then these triangles can be rather exciting or pretty scary based on the size of these triangles and the potential moves from them. If we look at the Qs, taking a look there, looks like starting to get a breakout. Are the Qs leading again? Are they foretelling that bond yields are going to go back down? All is going to be okay there. The dollar's not going to collapse, but lower yields could add into a little bit more downside pressure on the dollar. But I've been mentioning this big, huge triangle. I guess huge might be a little bit exaggerated, but a large symmetrical triangle here on the Qs. And there just wasn't, I wish there was, but I couldn't find um, a potential strangle on the Qs that worked within our risk management guidelines at Evo Trader. It would have been a very expensive strangle, and it's outside our risk parameters. It would have been there, but the other side of the coin is to get the cost anywhere around where it's reasonable on the risk side. The delta would be so low, we lose that delta gamma acceleration, and that's why we like to do strangles and do out of the money strangles around that 25 to 30 delta so that we get that delta gamma acceleration on the direction that whatever the security is in a triangle breaks. But when you go too far out of the money, the delta curve, if you've not seen it, it's like a big lazy S, but it's pretty flat, and then it goes vertically up, and then it flattens out again. It's not linear from lower left, upper right. So it's this big kind of lazy S. And we want to start right where the vertical move part starts. That's where the delta gamma acceleration is the greatest. If you go too far down the curve, because some people might say, oh, I'll just go down to a 10 delta and we can get in really cheap and buy a whole bunch of them. That part's true, but you're so far down the curve that the stock can move your direction for a while and you're just creeping up that delta curve. So you're not really making much money, if anything. And time's going to be working against you, and that kind of takes away whatever gains there would have been. So it's really precise on how we set up these strangles in the volatility portfolio. And I just couldn't find anything that worked with all that considered. So when you're in that scenario, you just let it break out, and then you can make a directional trade. You might wonder, did yesterday count as a breakout? Not to me, because we not only closed right on the upper trend line, the lower highs, but we didn't take out this spike higher here. This one got right to the same level as December. Almost looked like we were breaking out here. That's why you have to be cautious on these. If we can close up here with where we are on the Qs today, that would count as a breakout day. But that means today's the breakout day, and then we need the follow through or confirmation day. So don't jump in yet. It's too early. You know how triangles break out. Again, if you've listened, there's one of three ways. They break out and take off, they break out, test the breakout, and then run, or you get a false breakout where it looks like you're going one direction, and that's the head fake. The market loves to give head fakes, and the big move is the other direction. So all three of those possibilities are still in play. That's why it's too early to pick a direction here and jump in. If we do close up here near the highs of the day today, and if we get follow through tomorrow, then you can look to put on a bullish directional trade on the Qs. But today is too soon. So even if you're an aggressive trader, you know, I oftentimes give aggressive versus conservative type viewpoints because we all have different risk tolerances, and you undoubtedly know what yours are. But there are certain cases where it's even too soon to be aggressive. It's just really not prudent, and that's where we are right now today on the Qs. So let's take a look at. Oops, went to TNX. I meant to go to the IWM. That had a heck of a run. We've pulled back a bit here. Really think that we're going to see this C wave extension on the zigzag. the fly in the ointment there is that wave five was rather extended. That's what my concern's been on the Dow. We'll see if we can hold here on the 10-day moving average. If not, then um, probably coming down here to test that A wave high. From a purely technical standpoint, that's still okay. If that level were to hold and we turn and bounce higher, all good. Um, but it would be better for a continued upside move if we hold this 10-day moving average. So keeping a keen eye on where we are on the IWM. But as I said, it's not the end of the world if we come back and test this A wave high. A break below that, that's a different ball game because then we're coming all the way down here to the B. So important to see what happens in the next day or two on the IWM. If we can hold here and turn and mount a move back to the upside. Got a little bit vertical there. Perhaps we needed this little bit of a correction, but IWM has been the place to be this year. And you can see from very beginning of January, straight up on the IWM. A little bit of pullback is okay. And then another thing to look at, and hopefully a lot of you have thought of this already, could we be getting a zigzag here? And that's a possibility too. If that's the A wave, we come down here, we're at 33% on the low now. And if we do come down to the A wave, look at that. It's a perfect 50% correction. So there's another reason, not just from zigzag rules, but from Fibonacci rules, 50% correction is really good too. So that's why I'm not concerned if the IWM even comes down here to the A wave high. You got a 50% correction. And if we get there, then we're looking for another leg higher on the IWM. Does it need the rest of the market? Maybe. Would interest rates going down be helpful? Yes. Would interest rates going up significantly be harmful? Yes. So you can see there's questions everywhere in the market right now. And so we just manage expectations, be smart, be prudent, pick your best positions. There's still a lot of stocks that are working well. So just it's not a back up the truck, load the boat, any of those scenarios right now. But we could get there. The Qs continue to break up. The SPY continues to break up. Probably gives us another leg higher in the IWM. So the setup is there. I'm not trying to say like we can't go higher. There is a distinct possibility that we could have a big rally, but we don't have enough information yet. We need a little bit more before we can feel good about that. Finally, a little bit of pullback in UNG today. Needed to do it after this vertical move. How far back does it come, though, is going to be the key. I felt like maybe a little bit early on this call, but that once the storm passed, because obviously that helped put a bid under UNG, and it was the nature of this move that made me feel like this could be a good short-term trade. Not only did we get this first big gap up, but it was followed by another one. And we went right to the B wave, so we satisfied that zigzag rule that when a zigzag ends, then it was a 38.2% B wave correction, yields an expectation of 61.8 on the C wave. So another one that pegged it right, just like TLT, went right to the level it's supposed to. Again, I keep harping on this, but if you've been poo-pooing or not a fan of zigzags, you're missing out. Start learning. We have a lot of information on our website, educational information. We pride ourselves on the educational information there, on talking about zigzags, Elliott Wave, etc. But back to UNG. There was some follow through on the nature of the storm and all the reporting that came out. And we did make it up to this level of resistance, which was a possibility right here around 15. And we've backed off. So the question becomes, we're still well above the 10-day moving average. We still have these big gaps that could get filled at some point. And we just need to see. Now, if we break above 15, then there's probably another leg to the upside on natural gas. And we might even come up and test this high around 17 from December. But we're overbought right now. And if it wanted to break 15 at this moment, that would be okay, because when you break a point of resistance and you're already extended on the move, those moves tend not to hold. So not ready to give up on a bearish look at natural gas yet. But if we consolidate here, let the 10-day moving average catch up and then break above it, that's a different story. Then that probably tells us we've got another leg higher on natural gas. Then looking at oil, just kind of hanging around that 70 to 75 area. But look what's going on today. We've got a bit of a move up here again. We had a run up there earlier in January, came back down and had this backing and filling here. This is a perfect example when you keep hearing me use that phrase, backing and filling. We had this big vertical move. This is backing and filling. You back off a little bit, you kind of go sideways, you go up and down. That's what backing and filling means. And now it's given another leg up. We start to get above 75 here. And I think you're going to start to wonder, when is OPEC going to come out and announce another production increase, just like they did back over here. Every time we spiked up, they increased production. And I've been giving them kudos for quite some time on the job that they do managing the supply demand curve. They keep it right in this sweet spot area here in that 70 to 75 area. You could even extend it down to 65 to 75. I've joked about this before, not promoting the show or whatever, but it's been a popular show on streaming media, Landman. And I like the show, but it also had a segment where they talked about that, how important it was for them to manage the pricing where they want it to be higher, but not too high. And then they don't want it too low. They want it in the Goldilocks area. So I talked about that Goldilocks channel in the dollar. That's kind of the Goldilocks area for oil. And they've shown that that's what they do. It gets too high, they get concerned. They don't want prices at the pump to get so high that it kills demand, that we stop driving or we change our driving habits, because that doesn't help them, because then they know that could create a big crash down in the price of oil, and they don't want that. All right, let's move into the cryptos. Boy, they are trying to hold extremely important levels. We're going to get to the metals here in a minute, which are down. And the thought had been, at least some opinions in financial networks, that the big ascent in gold and silver had been hurting cryptos because everybody's running to gold and silver. And if we could get a correction in gold and silver, that might put a bid back under the cryptos. Well, we're down on gold and silver today, and we're just kind of staying steady as she goes, holding this area here. If you're long cryptos, you would love to see, at least as evidenced by the BITB for Bitcoin, hold right here at 47.5. If it doesn't, it's not the end of the world, because there's support down here at 45, which we tested back in November. So that's still a possibility. That wouldn't do a lot of technical damage. But look at the construction of this 5-wave pattern. That's a concern, because that's a pretty symmetrical Elliott Wave pattern. And I like symmetry in the patterns, not just the labeling, not just looking at the circles on whether it's a 1, 2, 3, or 4, whatever. I like the pattern to show symmetry. And we have that here on Bitcoin. And if that wave 5 comes to fruition, that means we've broken not only below 47.5, but we've broken below 45 as well. And that could get to be a Katie bar the door scenario there, Zach, because look at where that wave 5 is. The top of it here is at like 42, the midpoint under 40, and we could come all the way down under 30 on BITB. That's all a possibility. I'm not saying that's going to happen. I'm just saying that it's not a bad pattern, and that bears watching really, really closely. So if you're trading cryptos, then those are things to watch. Ethereum is going to be a little bit easier to read, because we're closer to, like, we could go down from 47.5 to 45 on Bitcoin, but Ethereum is at that level that would coordinate with 45 on BITB, the 20 level on Ethereum. If we break 20, then we have that C wave extension on the zigzag down to 61.5, And if that didn't hold, the next big level is back down here in this 12 and a half area. So again, a potential significant move lower, but we're not worried about it yet. We're trying to hold these support levels, but a break of those, and then it's a different game. It gets pretty scary in crypto land then. You can see the example here. That's why I went through those three examples of triangles. So we had a symmetrical triangle. It broke up, looked like we're off to the races. Nope, that was a head fake, and we came down. So that's a perfect example of what I'm talking about when sometimes a triangle breaks one direction, but that's the head fake, and then we go back the other way. So a lot to watch in crypto land over the coming future. So I did mention metals, and I guess you call that a pullback. Maybe that's why it's not enough to put a bid under the cryptos yet. Just a slight pullback on gold today, not too significant. And my goodness, if we do this for another day or two and let the 10-day moving average catch up, we could be off again in gold. As far as it's run, nobody, including myself that I listen to, thinks that the metals move is over, which that in its own right could be something to think about. When everybody gets on one side of a trade, the market tends to go the other way. It's the path of least resistance. When you're too overloaded with everybody viewing things one way, the opposite direction happens quite often because, again, it's easy for, in this case, the shorts to step in when everybody's long. So we'll see if we come back down to the 10-day moving average. If we don't make it, if we don't correct too much more than this and go sideways for a few days, yeah, we could have another leg up in the metals rather quickly. I think the more ideal scenario, if you're looking for an entry, we got out obviously way too soon. We had the miners and as well as gold in the past, but did not see this vertical of a move coming. And my disciplines will not allow me to chase vertical moves like that. It's too far, too fast. And normally those come back down with significant corrections. Will it happen in gold and silver? We'll see. A little bit of a move back down, a little more of a move lower in silver today than gold. But again, you can see the vertical nature of these moves. Same scenario though. If we just back and fill here a little bit in silver, let the 10-day moving average catch up, we could break higher. But it's also almost to the point, I think, where everyone is on one side of this trade and that we could turn and move lower a little bit more significantly than what's being shown so far. So lots of things to keep an eye on out there, Zach. Nothing is too clear cut at the moment, but on the positive side, with all these things that I've mentioned, it's not going to take too much more time before we get these answers. The answers should come within the next few trading days. By the end of the week, maybe the beginning of next week, we'll have a lot clearer picture of where things are likely to go from here. No one ever knows exactly where things are going to go, but a higher percentage chance of figuring it out over the information that we get over the next several trading days. All right, with that, Zach, we'll go ahead and turn it over to our Q&A. And as a reminder, we will do, as we do each and every week, a case study consideration. This week, we'll do that at the end of the show, and Zach will show you how to post that on the social media aspect of the platform.
Yes, indeed. All right, let's get right into it. I'm going to start out with a question here from Teddy on ONDS.
One sec. I'm going to turn the heat off because it's drying my throat out. So I stop coughing. 1 second. I'll be right back.
No worries. Even here in Florida, I'm experiencing effects of the Arctic storm that the rest of the country is dealing with at the moment. It was 76 yesterday afternoon, and by the end of the night was down to 37, supposed to get to 29, which again, I know is nothing compared to what most others are experiencing, but 29 in Florida with wind chill coming off the Atlantic is not fun. And again, I know I can only complain so much. There's a lot of people out there that have it a lot worse than I do, but cold in
Yeah,
Florida.
when you take a Florida boy and move him to the mountains, I get cold pretty quick. But I will say that 30 degrees in Florida, on the rare occasion that it gets down there, feels colder because of the humidity than 10 degrees up here. So I feel for you, Zach. I know it's cold there as well. All right. So I'm sorry. What was the symbol?
No worries. It's ONDS.
Let's take a look. Well, we're at an important level here. We're sitting right on support. We did tap the 10-day moving average on the high of the day, the low of the day, right there at support, which was the previous wave three high back in October. So this is key. If this wave five is indeed over, and it very well could be, you know what the rules are. If the wave five extends less than 100%, the corrective move works its way back down to the previous four. But in this case, you've got a couple ancillary things. We could hold right here at the wave three high. We got to get back above the 10-day moving average first. But the other side of the coin is that we have this $10 price level here. I don't know what the institutional ownership percentages are on this, if any, but that would be, if you're trading this stock, that would be something to know. Find out how much, what percentage of the float is owned by institutions, because based on securities rules, you heard me say this before, only investment companies with a registered investment objective of growth can own stocks uh, above 10. If it breaks below 10, then only institutions with aggressive growth can own those stocks. So it does look like, I mean, here's another pretty symmetrical five-wave pattern to the upside. Wave four right at 61.8 gives you an expectation of 100% extension. We almost went exactly there, and we're coming back down. But the keys here are first, can we hold this level right where we are on the low today? And if we break below that, will the institutions come in and support this $10 level if it tries to break below there? A positive is you could get a test of the 50-day moving average and still stay above 10. But boy, if we start to break down too much more from the lows today, and the institutions don't step in, that could be a rather swift move to the wave four. Institutions will decide if they want to stay in this position or not. If it starts to test that $10 level and break below it, if they want to stay in this long term, they'll come in and buy and they'll support the $10 level. If they're had enough, they're moving on to something else and they start selling because they know they're going to have to anyway at some point, you could see a rapid move down. So, really important, this level here between 10 and the low there around 12.
Thanks, Rob. Next up, we have Caesar with Tilray. I believe that symbol is TLRY.
You're right. I was wrong. I thought there was an A in there. Boy, I remember the days when we got asked about this every event, when all these stocks were so big in the early days of this industry becoming legal in a lot of places, etc. But here we are with that same scenario I was just talking about with ONDS. We're breaking below 10. We've got a wave five lower here. This isn't the same nice symmetrical pattern, though, that ONDS had. We had a rather quick ascent here to the wave four. We did barely hold under the 78.6% fib level, the last bastion of fib support or resistance. And we've headed back down, but we're just kind of meandering here below the 10-day moving average. Very likely, I would think that we're going to test that wave three low at 7.5. And again, I do think there's pretty decent institutional ownership here. But I don't know if those are institutions registered as aggressive growth, which would be my guess, versus those in growth. I feel like this is a little more of a aggressive type sector to be in. So we'll have to watch and see um, this move lower. It could literally drift all the way down here to the tap box, all the way down to 5 before we start talking about that institutional support. The fact that we broke 10 and there really hasn't been much of a significant buying attempt here makes it seem like a further drift lower is likely here.
Thanks, Rob. Next up, we have a request for Oracle or ORCO for Barbara.
Yep, got that one. After that wild earnings report that it had back here when their earnings were just okay, but they announced incredible guidance that nobody expected, and bam, you had that big move up. But that was it. Everything has just kind of worked its way down since then. So that caught the shorts off guard, but wasn't able to follow through and get above 325, and we've just been meandering our way down. These levels are kind of similar to what I was talking about on the SPY, a rather weak wave 4 bounce, just under 30%. And then the extension here, we're down to the 38.2% fib level, which is trying to hold here. So the key on Oracle for the short term is, can we hold 175? That's important. If we break below 175, then there's probably a decent chance that we're coming down, maybe even as low as 100, if you can believe that. That would be surprising. The top of the tap box, though, is around 130 or 132 or so. But 175, at least for the short to intermediate term, is key. If we can hold that and bounce, it could be the end of the entire 5-wave pattern, and that would bring us back up to an expectation of 225. So how we handle this 175 level is going to determine basically the next 50 points movement out of Oracle. Do we bounce up 50 points or do we continue down 50 points? So almost worthy of a strangle there. In fact, I wonder if the pricing, because the options are very liquid, might be one to keep an eye on. It's not a triangle pattern, so it wouldn't be like an ideal scenario for a strangle, but boy, that has been flat. Let's see where the ADX is. It's a little too high, so I'd kind of take that back. We could continue kind of this sideways stuff here for a while.
Thanks, Rob. Next up, let's head over to SKYT for Lisa. And I was going to say perhaps that Oracle Strangle might be a good one for a good candidate for the speculative portfolio.
It could be, yeah, since it doesn't follow the triangle rules. But I'll take a look at where the option prices are. Boy, you've had a pretty strong move here on Skywater. You can see that ADX got above 40, so you got to keep an eye on that. It's fine as long as it doesn't break back below 40. When the ADX breaks above 40, you're good until it breaks down below 40. That tells you that that part of the move, at least, is over. And so you expect a corrective phase. Doesn't mean the stock can't go higher down the road. It just means that particular part of the move is over. But for now, in the short term, we are holding the 10-day moving average. So that's good. We've got some nice consolidation here. Last time we did kind of this sideways consolidation, it took another leg up, and it may very well do that again. So this is the action that you want to see when you get some slightly vertical moves for it to hold and then have a chance to continue higher. So I'd still keep an eye on this if I was long. There's nothing that says exit. An exit would be if we were to break below 30. So as long as 30 holds, I think you're good there. But a break below 30, we're probably coming down here to 25 rather quickly. So that's the key level to watch.
Thanks, Rob. Next up, got Maria. A couple of symbols. First one, ACLS. Both look like triangles. What are your thoughts? I'll give you the second symbol after.
Okay, well, let's take a look. Yeah, uh, not the longest formed triangle. It's about a month in, but pretty good set of higher lows and lower highs here. Width of the triangles pretty decent. The mouth is from 85 to 115 points, $90 stock. That satisfies that rule. The rule I'm talking about is you want the mouth of the triangle to give you a projected move that's at least 10% of the stock price. So with a $90 stock, you want the mouth of the triangle to give you an expectation of nine or more points move. Anything less than that, anything less than 10%, and you're putting on a strangle with a still a chance of a profit. It's just a low percentage profit. Um, and so is it worth putting on the risk when you know your return isn't going to be very high? But in this case, 15 points could be a good one. So, yeah, we'll keep an eye on that. What's the next one?
Next one is AEIS. Same question.
Well, with the fact that the energy sector has been all over the map, I kind of like the setup here. Maria, a $260 stock, a little bit of concern about what's the cost of the options. Um, Nice little triangle there, and it's right at 10%. So you could argue just below 250 to 275, round it down to a 25 point expected move. It's a $260 stock, so 10% would be $26. So the setup looks good, and the potential move is likely to happen. In other words, a breakout, but it's going to be real borderline. And what we want is we want to try to set them up to where we can get at least a 30% return. If we get a reasonable breakout in a reasonable amount of time, 30 to 70% is the range you want to look for as far as a profit in a strangle. And that would be at the lower end, but 30% is 30%. So if the option prices work, um, this got it could actually, if it broke to the downside, they don't have to stop at the mouth of the triangle. They can outsize it. That's just the guideline. It could likely come all the way down here to 225 because that was huge resistance. It broke above it. It may break down and test it. So even though it's borderline, if the option pricing works, yeah, like the looks of that one. Good job, Maria.
Yes, indeed. Good eyes there. Next up is Rivian, RIVN.
Here we go again. You've heard me say it 1,000 times, but I'm going to say it 1,001. I like the car better than the stock. Um, and last time we looked at it, it was looking rather ugly, and that hasn't changed. Continued down from the last time we looked at it, and we've retraced the C wave back down to where the B was, and we're continuing to break lower. That's where we had to hold. We had to hold right here. It tried, but it just turned out to be an oversold bounce. We were a little below the 10-day moving average. It came back up. The wave four, right around 70%, even though Elliott acknowledged that 78.6% can hold because it's a fib level. He felt that if you got a wave four at 70%, the likelihood is that that pattern would become disqualified. So we're kind of getting in that area. And the fact that we didn't hold this level here where the B wave was, especially on the breakdown today, leads you to the next likely spot is right all the way down to the very beginning of the zigzag. So that would give you a price target here, right around 1385 or so, is a likely possibility here. We're getting a little oversold again on the low, setting up the same type of scenario that we had on this bounce right here last week. So, yeah, looking like maybe it wants to come down to at least this level here of the 0 point. And then the big support is even a little bit lower, just above 12 and a half. So
Thanks,
that
Rob.
one looks kind of dicey right now. I think that one wants to go lower.
Very well. This next question here is from a new subscriber of ours. So welcome aboard. Great to have you with us. First question is going to be, or question is on how to figure out the waves, e.g. SLV is in a wave 3, but it is teal, not purple. So my question is, how far back does it have to reverse to see the 3 turn purple? And is there any chance of making money on a wave 4 before the 3 turns to purple or starts a wave 5? Hope that makes sense.
Yeah, it does. And the answer to the last part of your question is yes, but I missed the symbol there. Zach, what was the symbol?
That was on SLV.
Oh, SLV. Okay. I know you're trying to help me out because I give long-winded answers and you're trying to get the questions out quick. I just missed what the symbol was. Um, so the question regarding the wave 4, yeah, the wave 3 is still green, which means the algorithm is not convinced that that's the end of the wave 3 and that we are starting the wave 4. It could be. The question on how far down does it have to come before you label a wave 4, is the two words that I hated the most when I was first learning and going through my educational process. Gosh, going on 30 years ago now. But when I was learning and in seminars and webinars, well, there weren't really webinars back there, seminars, when the instructor would say, it depends, that would drive me crazy because I just felt like that was avoiding the question. But as I've gone through the years, I've learned what they're talking about. It does depend. What happens can change the expected outcome. In general terms, it's all up to the algorithm. How far down does it come? The guideline is once you get in the area of a 23.6%, the first fib level, and it may label it at 21 and a half or 22, but that's where you start looking for the labeling on a wave 4. So we could come down a bit further here. If we do a fib retracement, let's find out where the 23.6% level is, and I can give you a better answer. So here was the start of that last part of the run, and there's the 38.2% level, and I can edit these to turn on the 23.6% level. So we'll turn that one on for now. And there it is. There's a potential for a wave 4 to become labeled right in here, right around 92. Let's just call this rounded down to 92. So if it got down to 92, there's the possibility. It doesn't mean that the algorithm will find everything else that it needs. And I always try to say that Elliott Wave is not as easy as some people try to make it out to. The algorithm is extremely detailed and complicated, and it takes a lot of information into being. So I can give you generalities, and that's one of them, that you get around a 23.6% retracement. That's where you can start looking for a wave 4, but it doesn't necessarily mean it's going to label it a 4 if the rest of the math, if you will, don't work within the algorithm. You could just get a zigzag retracement that doesn't label a wave 4. But I think the answer to your question was, how much can you make before the wave 4 is labeled on the way down, before it's actually labeled? That's the guideline. You could expect it to move down to 23.6 before you even get a wave 4. So yeah, it's possible to profit on a downward move even before a wave 4 is labeled. I hope I understood the question correctly.
Next question is going to be on Mara, M-A-R-A.
Yeah, so we looked at Clean Spark yesterday with the Evo show, looking at these crypto miners. They're going to be all, Clean Spark actually looked a little bit better than the charts of Bitcoin, but they're just kind of hanging around down here. I believe Mara is pretty well institutionally owned. I could be wrong there. I have to go back and look. So you can see how it's trying to defend this $10 level. And it seems like institutions they're not coming in. pardon me, guns a-blazing, trying to support the $10 level. They're just kind of doing enough to keep it above 10. So we'll see if that can hold. But a break of 10, and it's a whole different can of worms here. That five, the wave five tap box down around $5 really comes into play. That would be in real serious danger of occurring if we break below 10. See how it broke below here and they came in and supported it, got it back above 10. But oftentimes, institutions, when they see a stock that's been shorted like this, will come in with big volume and they try to force the shorts to cover. And then that's when you can get a more extended bounce back off of the $10 level. They haven't done that. They're just kind of tiptoeing in on support, holding it above 10. That may mean they're concerned about the $10 level holding. And if they have to get out, they want to have as few shares as they can possibly have to try to hold 10 and then get rid of if it breaks below it. Now, on the positive side, the wave 5 is labeled and it is purple, and that wave 5 could be over, and we could just be consolidating for a bounce back up to the previous 4, which would get us back to 12 and a half. That's a possibility as well. But this one's kind of an easy read. You just got to watch the $10 level. If it bounces above it, your next level to watch is 12 and a half. If it breaks below it, if you're long, that's your stop. Get out as quick as you can.
Thanks, Rob. We still have a good number of outstanding questions, but I see we're running after time and we still have to do the case study consideration for this week. So if you want to transition over to that, please feel free.
Well, let's do two more since I've been annoying with the coughing. I know how annoying that is on the other end. So if there's two more questions, and we'll take those, and then we'll do the case study real quick.
Yeah, no, absolutely. I'm more than happy to pass them through. But I will say it's not annoying. I think everyone can empathize and is in a similar situation. I know when I have heat going, the arch enemy is talking and not trying not to cough. So anyways, not to ramble further, OIH rather, for Will.
Oh. All right, Will, let's see what we got here. You're in an oil services ETF. And as you would expect, with oil moving higher, that's the ideal scenario for these services stocks or ETFs, either one, making a nice move. We're at 350. It's not quite the same effect as the big round numbers like 300 or 400 would be. It's a pretty good move. It's slightly higher degree than 45, but that's a lot better looking ascent than some of the other stocks that we look at. I kind of hope that doesn't continue higher because then that means oil goes a lot higher as well. But gosh, when you look at the DMI, you couldn't really ask for much more than that. The ADX getting close to 40, but still below the positive directional indicator, which is moving higher. Big separation between the positive and negative directional indicators, and the negative directional indicator is going low. It's not perfect because the ADX is a little higher, but it's pretty darn good. We're a tiny bit, but not significantly so, overbought. And you might look at that and say, that doesn't look that much overbought. But I've been getting this question a lot as well with that, no security in any time frame gets too far from the 10-day moving average for long. People want an X percentage, and there just isn't one. It depends on, there we go again, it depends on each stock. Some stocks are more volatile. They get further away from the 10-day moving average before you would consider it too far away. And then when you look at this, you can see how much this really hugs the 10-day moving average. See how it just never gets very far away from it. This trends right along it. So this is actually kind of a little on the outskirts of being almost too far from the 10-day moving average. So I wouldn't be surprised if we go sideways to maybe slightly down over the next couple of trading days. But looking at that DMI, this definitely has the potential of moving higher from here. So I'd keep an eye on that one, Will. I think that looks good.
From there, let's head over to Apple, AAPL.
There's so much talk about Apple now because this pullback so far. Everybody wants to know, when is it time? When is it going to be Apple's time again? And maybe we're starting to get there. I don't know if this is just a bounce because we got so sold. What I do know is that we satisfied again the zigzag. Hey, it was a good one to finish on, Zach. Good call. The A down here, right to the 50-day moving average, a perfect 50% B wave correction. That leads you to 100% expectation on the C wave down. Look what happened. We got there and we pegged there for a week or so. If you break that extension level, you look for the next fib extension, which is 161.8, and that's where it went. And then oftentimes that's it. You get an extended C wave, you get one more fib level, and then you're pretty well exhausted. So that was a bit oversold based on the zigzag, and we're getting the spring back here. Um, Little gap up today in Apple. It's becoming interesting. Not that far from the 10-day moving average. Don't like the gap, especially in Apple, but the 50-day moving average looms here. So if you're super aggressive, maybe you take this as a sign to get in. I do still think the more prudent way is let's let it get back above the 50-day moving average first, because if it does, remember the zigzag rules. The C wave gets retraced, and that could bring us all the way back up here at about 278 or so, as we should go back to where this B wave was. So my point is, I think you can be patient here. Let it get above the 50-day moving average without giving away too much potential profit, because you still have a pretty decent move uh, uh, potential up to where that B wave is. So, gosh, how many examples did we show where the zigzags nailed it to a T? I mean, they weren't even like, well, it got close, or, it was fairly accurate. These stocks have been bouncing off the levels dead on. So please, if you're not a fan of zigzags, put any preconceived notions away and take a look at them. They can help your directional trading. All right, let's see what we can find for our case study consideration today. IEZ. Here you go, Will. Goodness. You looked at the OIH, and this, if you were, if you weren't convinced when I said that one could go higher, well, here we go. The AI has given us a 77% score that this goes higher. Now, just one note of caution. We might get a little pullback here because this one's a little separated from the 10-day moving average. So maybe after a little backing and filling here, we go higher. So that's going to be our case study consideration. Zach, I know we're running late, but maybe real quickly you could go through and show them how to do an idea.
Okay, sure thing. I will take the screen over now. Alrighty, we should have it. We are now to menu view, jumping off point for the hub platform. And as Rob said, we're going to post an official idea for this week's case study consideration. So we'll go over here to the right toolbar to select the light bulb or ideas. And right now it's loading the ever-growing idea list from our growing community and the hub platform. And I will come back to this after we post the idea to show how we can interact. So as Rob said, again, this is going to be an official idea, which you could equate to paper trading, as it's going to have all the same data that you would if you were actually executing the trade in real time with your broker. So Rob, remind me again what the target price is on that one.
Oh, the target price is 27.85.
27.
Just call it 27.50.
27.50, you got it. So as we can see, I had the symbol search up there. What time frame we're looking at there, Rob?
You can go with the standard 3 months.
3 months. So we'll go a quarter out, and we'll label this that we are bullish, as we don't need IEZ repeated twice, as we'll see it in the symbol window, and then the title, it can be a bit more descriptive about what the idea is looking for. But We will come back and add more details, Rob's chart, and some supporting evidence, his overall rationale after this session concludes. But we'll see here as I hit confirm. We will publish the idea, and it's now going to be available on this trade list for you to come in and interact and agree or disagree. And whether you agree or disagree, we encourage you to share your thoughts and opinion on things, as we know that opposing opinions is what makes markets. If everyone agreed, if you equated that to agreeing to buying and it was all buyer's market, or if you equate disagreeing to selling and it was all seller's market, there would be no options, no open interest, no liquidity, nothing to take part in, as there has to be both a buyer and a seller in every single option. So, or option trade rather. So we will see this list populate here and see that it's now available. Just for an example, I'm going to click on this idea to show how you can agree and disagree. And again, up here, after being able to take advantage of that capability, you have the option to reply, add your commentary and thoughts on your opinion as well. So I see we're 10 minutes after time, so I'm going to stop rambling and let Rob close things out. But other than that, thank you for everyone that took time out of their day or night, depending on where you are, to attend live with us. It's always a pleasure to interact. And back over to you, Rob.
I second that. Try to, as often as I can, say how much we value people's time. Time's the most valuable asset that we all have. We talk about trading assets, etc., but time is the most valuable. We do appreciate you spending your time with us, and we do our best to make it a educational, informative use of your time. Lastly, gosh, if you don't have this software, I've sung the praises of the Elliott Wave. To me, it's the best Elliott Wave software that exists, because it's programmed exactly to the algorithm that Ralph Nelson Elliott wrote. No personal adaptations involved, which a lot of Elliott Wave software programs have. And then you add in the social media aspect, which is growing daily. Literally every day I get a notification that somebody else is subscribed to it. The Hub organization keeps me posted on that. So if you haven't gotten a copy of it, go to hub.com and get a copy of it. It's an amazing piece of software and does a lot of things, fun to play around with and see all the tools and bells and whistles, etc. And it's only getting better. They have programmers literally working around the clock, adding features all the time. So with that, thanks again. Look forward